There is a current commercial out there that has recently caught my attention. It references all the many phrases that use gold to highlight excellence, like gold standard, heart of gold, and so on. Now, here are a few more ways that we use gold as a definition. For example, a gold record is a song or album that sells 500,000 units. A golden cross is used in technical analysis that occurs when the 50-day moving average crosses above the 200-day moving average for measuring things like an individual stock, a bond, an index, and so on. A golden handcuff is a set of incentives offered by a company designed to be so financially rewarding that the employee will remain for the long term. In the world of investment strategy, we talk about gold as an asset class. We talked about gold on this podcast almost exactly a year ago. And today, we're talking about it again. I'm Philip Petursson, Chief Investment Strategist at IG Wealth Management. Join me each week as we discuss the trends dominating the investment landscape. It's the week of February 10th, so listen on as we navigate the living market. Here are a few enlightening statistics on the performance of gold recently. As of last Friday, gold has outperformed the S&P 500 price index over the last 1, 3, and 5 years. Now, let's not get too far ahead of ourselves. Gold has also had long periods of underperformance relative to stocks. The trickiest thing about gold is, how does one value it? How do we know when it's undervalued or overvalued? Well, first thing we want to do is look at the cost of extraction, what it costs a mining company to pull out and refine 1 ounce of gold. One of the top gold producers in the world is Agnico Eagle Mines. In 2023, its mining costs totaled approximately $865 per ounce. Other estimates put the industry mining and refinement costs at about $1,200 an ounce. So that puts in the floor for the price of gold. But it doesn't explain the difference between the current price, near $2,900 an ounce, and the current production costs of, let's say, $1,200. Well, now let's look at the value of gold as a currency, or as an eventual inflation hedge. Now, let me be more specific here. When I say inflation hedge, I mean a monetary inflation hedge. Our work suggests that over the long term, gold moves in a similar fashion to the expansion of the U.S. money supply, measured by M2. M2 is a measure of the money supply that includes cash and coins, demand deposits, including checking and savings accounts, as well as short-term deposits. As the amount of money in circulation increases, the value of gold historically has increased as well. Since the U.S. moved off of the gold standard in the 1970s, gold has continued to track the total amount of money in circulation and has moved higher as the money supply has moved higher. Now, these moves are not matched month by month, but they are eventually and inevitably. It seems that gold eventually catches up to the amount of U.S. dollars floating around out there. To put it another way, while the U.S. moved its currency off of the gold standard, the market kept measuring gold to the U.S. dollar. The more dollars printed, the more gold moves higher. In this case, gold is a currency that holds its value against the devaluation of the U.S. dollar. So why has gold seen such a good run then over the last couple of years? Well, one reason is that it has finally caught up to the massive monetary expansion during the COVID years. Remember, in the United States and Canada and other areas around the world, during COVID, governments flooded their economies with cash that didn't exist before 2019. So we've seen gold catch up to all of this effectively money printing that has occurred over the last number of years. It wasn't an immediate move, but it has been an eventual move higher. The second reason why gold has performed well may have more to do with the political uncertainty in the United States. In addition to being a currency with a seemingly built-in inflation hedge, gold has also served as a safe haven trade. It has been where investors flock to in times of uncertainty. If investors are unsure of what the new administration's policies in the United States will do to the U.S. economy, or to the global economy for that matter, what tariffs might mean for inflation and bond yields, what it might mean for corporate profits, then what is the alternative? The alternative is an uncorrelated asset that has a unique characteristic of wealth preservation, one that we think is serving its purpose as a diversifier against other asset class risks. I'm Philip Petursson. You've been listening to Living Markets Podcast. If you've enjoyed this podcast, please take a moment to rate it or share it with colleagues and friends. It will help other like-minded individuals find us. Thanks for listening.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purpose, and IG Wealth Management is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from expressed herein. Our views are subject to change based on market conditions. Commissions, fees, and expenses may be associated with mutual fund investments. Read the prospectus before investing. Mutual funds are not guaranteed, values change frequently, and past performance may not be repeated.